Jim O'Neill joins us now, and let's understand from Jim what he makes of Donald Trump's victory and the fact that Republicans now will be are back, and how will things change under Donald Trump now that it appears that America has voted for extreme right. Jim, always a pleasure to have you on ET Now. Thank you for joining us. Markets, I'm talking about equity markets, are celebrating Donald Trump's victory. Is there merit in that? Is there merit in believing that a Republican regime will be better for equity markets and for US economy and for world in general?
Well, I think, first of all, thank you for having me on. Secondly, my strongest comment is I think we have to be careful to not rush to too strong a conclusions because, as we've learned, Donald Trump is quite unpredictable, and whether he ends up being able to deliver all of what he suggested in the campaign will depend on partly whether the Republicans get control of the House as well as the Senate, which looks like it's a done deal, but also whether he really means everything he said. Thirdly, with those caveats, I think mechanically it is a net positive for the stock market because of his proposals for a corporate tax cut. And of course, with it, an absolutely enormous fiscal stimulus. But I quickly follow that by saying we have to keep our eyes on the bond market, which I'm sure your viewers and audience have followed closely the past few weeks, has seen a significant sell-off as the markets increase their probability of a Trump victory. And if the bond markets continue to deteriorate, and in line with it, the Federal Reserve changes its view of where the future interest rates are going to go, that would end up being a challenge at some point to the US equity market. And with it, with a strong dollar, would end up being a challenge for other markets around the world to some extent, including many so-called emerging markets. So, a lot of uncertainty. The initial reaction is quite logical, but I think we have to be careful projecting what's happened in the past few hours as being definitely what's going to happen in coming weeks.
Jim, it is widely believed that Donald Trump will continue to keep the corporate tax regime lower. B, he would introduce higher tariffs, which could be anti-globalization, which clearly means that he would push the American industry and American economy forward. What kind of implications and ramifications do you think that will have on markets in general?
Well, this is partly why the bond market is worried as well as the fiscal boost. I think you ask anybody with an economics training, and they would say that the introduction of tariffs, the way that he has proposed, is essentially a protectionist and inflationary measure, and especially if it's done against the background of a significant stimulus to an already tight labor market. I think you'll have a lot of people worrying about inflation and whether this really does help the medium to long-term competitive nature of the US economy. And so I think that's partly amongst many other reasons why I say we have to be careful in assuming that this initial buoyant mood of equity markets would persist. A lot will depend on whether the Republicans end up winning control of the House, because if they don't and the Democrats keep control of that, then that would constrain some of the ability to get some of these proposals through, although possibly not the tariffs. But, I am not a fan of tariffs. I think the past 100 years has showed that more and more tariffs are not good for world trade. And ultimately, this idea that the US can use tariffs to rebuild America, it's not really based on a lot of long-term evidence. And the only way that could really happen is the US changes its domestic mix between savings and investment and saves a lot more. And so they don't need so much foreign capital. But I think we have to watch really carefully the balance of power in Congress and what a President-elect Trump is actually now going to say compared with what he said last week or the week before.
How do you expect Donald 2.0 to be different from Donald 1.0, which is in terms of a basic approach?
I mean, I don't mean to sound repetitive, but the thing we know about Donald Trump is that you can't be sure whether he's going to do what he often says. So I don't know is the answer, is my honest answer to that. The second thing I would say quickly, however, is that with such a seeming big victory and the fact that I think it means he couldn't run again, he's going to be less encumbered by the idea of trying to win again. And because he's got such a mandate and he's done it once, you would think he will have learned from some of the things that stopped him doing what he wanted in his first term. So I'm guessing cautiously that he will try to go ahead with a lot of the instincts, particularly if he's got such a big victory, because he will quite rightly judge it as a message that the American people liked what he said. Whether we are around the rest of the world, particularly here in Europe, I think a lot of leaders and a lot of people in Europe are pretty concerned this morning. But we have to recognize that if you have a democratic system, and this is what the US population have voted for, the person that's leading the country will try to deliver some of what he said that has given him the mandate to be president.
Jim, it is widely believed that Donald Trump is anti-China, which is pro-India. Do you think this anti-China rhetoric, especially in areas of cheap imports which are happening from China, will only gain further momentum?
I mean, I think it's the right assumption to make. I think it would be very difficult for Trump to back away from that particular proposal because it's such a loud and frequent policy plan of his. But I quickly add again that as the nature of his personality is, he seems to like to do trades and deals with various leaders around the world. So some of it might end up being a negotiating tactic with China. But I think it's the right assumption to make that this is, all else being equal, this is not great for China, and it's probably is good for India within the Asian context. Although you can't ignore it about all the other things I've said because everything else is not equal. And if we have an enormous sell-off in the bond markets and the dollar gets stronger and stronger, that's going to challenge a lot of markets around the world, and to some degree, possibly even including India.
Jim, if I take the clock back, and I'll take the clock back to 2016, when Donald Trump was not supposed to win, and yet he surprised everybody when he was elected for the first term. And I remember that time markets went into a panic mode, and Wall Street, in a sense, reacted sharply on the downside. The reaction this time around, when Donald Trump has been voted back to power, is strikingly different. So why the same market have reacted differently to Mr. Trump's voting to power?
It's a very, very good observation, and it just goes to tell you that markets switch onto a theme and they stick with that theme until it turns wrong. So the fact that you make that observation is also part of why I'm suggesting one should be careful in projecting what is the immediate reaction in equity markets as being the permanent one. Because as we've seen in the past couple of years, if the bond market keeps selling off and we see higher yields, especially I emphasize, if it results in changing the Federal Reserve's plan of interest rates, then for a stock market that is not cheap, then at some point it will turn out to be a bad development for the stock market and the mood will quickly change. So I think investors should be careful before making too bigger, stronger conclusions.
Jim, if I look at the long-term picture, whether it's Republicans or whether it is Democrats, there is no real history which in a sense indicates that what regime is better. I'm talking about not 1 week or 1 month, I'm talking about for a term. I mean, there are phases when the markets have gone up even when Democrats were in power. And there are phases when markets have gone down when Republicans have been in power. So do you think we should not really try and read too much into the initial reaction like you initially said?
I very much think that. There is no evidence that historically that either a Republican or a Democrat president is always going to be better or worse for the markets. And there's a very simple reason. It depends on the cyclical state of the economy, and it depends on what's going on with the inflation environment, and it depends what happens with fiscal and monetary policy. And the best environment for stocks is, of course, typically a non-inflationary, modest to decent growth outlook, which has happened under very different presidents. But what the markets don't like and won't like is an economy that is sufficiently strong that there is a very tight labor market and a reoccurrence of inflationary pressures and concerns about the amount of funding that the US government has to do via the bond market. And that wouldn't make if you go back to the days of Ronald Reagan, which is really where I first started my time in the financial markets, the bond markets didn't like that. And there were times during Reagan's regime, including the famous 87 crash, where the stock markets didn't like it at all. So it's going to depend on a lot of normal things once we get over the excitement and emotion of the days surrounding the election itself.
Jim, irrespective of how things will change and things may not change under the new administration, if you have to identify or advise our viewers to perhaps park their wealth in one asset class or two asset class for the next 4 or 5 years, which are those two asset classes?
Yeah, I'd say I'm not going to do it. I'd tell your viewers and audience to not listen to me. But if I had no choice, I think I would, particularly given how much interest rates have risen, I would keep a bit more in cash than usual, partly because there is such huge uncertainty out there. We have no idea what will now happen about the war in Ukraine. We have no idea about the Middle East. We have no idea what a new US leadership will do about the so-called Iranian threat. We don't really know what's going to happen with Chinese fiscal policy still, which is a very important thing that will happen in the next week or so. On top of everything else I've said, so I think there's a lot of uncertainty. US stocks especially are trading on a very, very high historic multiple. And that suggests that over the next few years, it will be very, very difficult for the market to achieve the same kind of returns. And I think on a relative basis, stocks around the rest of the world look more attractive from a valuation perspective, but I quickly add that they often have done for a while. But I think whether they would then outperform greatly depends on what happens to interest rates and the dollar. And so there's a lot of uncertainties here, and I wouldn't want to give such strong advice for another couple of weeks at least until I develop more confidence as to where the policy environment's going to go, particularly as it relates to inflation and what the Fed's going to be doing.
Final question. Stocks are expensive, bond yields are moving higher, and bond yields in US are now meaningfully above 4%, which frankly is not a bad return for a long-term investor. If you have to choose between equities and bonds for next 5 years, where do you think greater return and greater margin of safety is? Is it still in equities, or one should hide under the comfort of bonds which are offering decent returns now?
I think at some point the answer to that would be bonds, but as I have suggested and keep hinting, I'm concerned as to where the bond market might go in the next few weeks and months, because this election has come against the background of a very strong belief that the Fed's going to be cutting interest rates a lot in the next 18 months. And that might turn out to no longer be true if Trump can deliver all the policies that he's said in advance. And if that's the case, then the bond market's going to probably deteriorate further. And so I think over the next 5 years, bonds might end up giving a better return than equities, but I think there's going to be a better level to consider that making that trade than we have today. Is my guess.
Well, Jim O'Neill, really appreciate your time. Always a pleasure to have you on ET now, and certainly hope to see much more of you going forward. Let's take a break with the news that we've got a powerful recovery on the index. From yesterday's low, which was below 24,000, we are at 2450, which means we've seen a sizable rally. It's one event risk which is now behind us, which is what I think markets are celebrating. And you know what markets are? Just think about it. 2016, when Donald Trump had a surprise victory, the market went into a tailspin. Today, Donald Trump has had an obvious victory and markets are celebrating. So it's the positioning of the market which always is important in the near term to understand what happens in the short term. In the short term, nothing meaningful changes, but in the long term, a lot will change depending on the economic policies of the Republican administration. The bond market, tariffs, corporate taxes, law on immigration laws, global bilateral trades, the existence of NATO. All these factors are something which I guess it's only time will tell which way the new American administration would move. But today it's all about a relief rally. Today it's all about a surge. Today it's all about a spike. Today it's all about more like an event risk which finally is behind us. Let's take a break. Markets are rolling and exhibiting a lot of strength.
If you like this video, then like, share and subscribe to ET Now.